Good morning. Today is Tuesday, November 29th. Thanks for joining us. Almost the last month. We're getting into the Christmas season for sure. We might have to get some tunes on the show in the next few days or something. Once we get that sorted out. But we're going to start off today with China again. Again, yesterday the big news was China. It really took the markets down about 1.5% or a little bit more during the day. The big issue was, what is Xi Jinping's move going to be? And it seems like he basically did an all of the above strategy. He is looking at a combination of heavy police presence, pared back COVID restrictions. For example, they're now allowing you to quarantine at home, which is pretty remarkable to me that you weren't even allowed to quarantine at home before. And they're also looking to accelerate vaccinations, especially among seniors. And that's fueling a rebound in the stock market. The Hang Seng, which is the Hong Kong Stock Exchange, that was up over 5% overnight. And the two-day move is now up more than 3.5%. So more than compensated for the decline yesterday in China. That's not happening in US stocks. US stocks are rebounding a little bit, but not recouping the losses from yesterday, despite the rally we've had so far this quarter. Tom, what are your thoughts about China right now? And where do you think they go from here? Is this another head fake? It seems like each day we come in and the news is the opposite way.
I think they've just got to figure it out. I think that they've held on to the zero COVID too long. They're seeing what happened everywhere else where they held on for too long. Australia, New Zealand, Canada, you name it. And they're just gonna have to work through this. And I think that the lockdowns will probably become less and less frequent, less extreme, just like they have everywhere else in the world. And they're eventually going to get through this. But I think I think they're seeing now it's silly, and I think the political ramifications now as well are starting to really bite them. There are a lot of people in China, they all decide at the same time that they don't want to be under that rule anymore. It could get very crazy very quickly. So I think that that's really the move that they're looking to do, is just kind of chill out, figure out a solution, and move towards a more normalized version, or at least a more Western attack in terms of how we're taking care of COVID.
Well, and for that Western attack, you do have news internationally today out of the IMF telling China that they need to be a little bit more flexible and back down from their zero COVID policy, move to a more, quote, targeted approach. And you also have news out of the United States with Bank of America CEO Brian Moynihan saying that he fully expects there to be a supply chain impact of these COVID lockdowns in China. And I mean, clearly that's happened. I mean, I think that's an unequivocal fact. The fact that iPhone sales, for example, are being pushed out into the March quarter because of the lockdowns that we've seen in China. So it's going to happen. The supply chain is going to rear its ugly head again, just as inventory at retailers are starting to come down. So that'll be very interesting as it relates to where we go from here. And we're going to actually skip ahead because this fits along the supply chain side. But we also have the rail workers potentially striking beginning on December 9th. So what happened here is the rail workers were going back and forth. The rail unions were going back and forth with the rail companies. They couldn't come to an agreement. So what happens is Congress has to step in and basically negotiate an agreement. The executive branch steps in. So that's what happened. The Labor Secretary, Marty Walsh, helped broker an agreement that would have led to 25% pay increases from 2020 to 2025 for rail workers. And on November 21st, the labor unions had a vote, but 53% of the people who voted against it. They didn't think that the agreement fully addressed the issues. They said that they wanted the rail companies to address the deeper concerns, which is a business model that seeks to minimize labor costs and results in chronic understaffing. And essentially what they're saying is that they just don't have time off. They don't have any flexibility. They get pulled in, they're working all the time, and they don't have any ability for work-life balance. And that's not being addressed by the agreement. On the administration side, they are now going to Congress and demanding that Congress demands that the rail unions do not strike, which Congress does have the power to do under federal law. Congress can instruct the unions not to strike and accept the negotiated agreement. It all creates some big headaches for the administration. I don't expect a strike, but I do think that Congress may have to act, and that may not be very favorable for the administration. Tom, what are your thoughts?
Yeah, I think that at this point, I don't think that Biden will just serve a second term. He ran really hard on being a union guy. I think he got a lot of traction there, but this is the opposite of that. He's basically saying, at the end of the day, you guys got to go to work. I'm not going to sit here and hold your hand through this whole process. He's going to force it through. Obviously, midterms are over. This isn't going to have any impact on any elected officials that are under that administration. I mean, at the end of the day, this is America, right? Capitalism is king. We're not out here to appease every single union and give them everything they want. And so I think that's what's going to happen. They're going to force it through. People have to go to work, and we're going to have to move on. I don't think it's going to hurt the Democratic Party so much. I think that Biden probably isn't going to have a great reputation with the unions after that, but I don't think that really matters, to be honest. So it's a good political move just to get it done and not have a massive strike on our hands.
Yeah, I mean, it sounds tough to say, hey, this is America, this is what happens. This is called capitalism.
Yeah.
You do try to minimize your costs and maximize your profit. That's why we have the economy that we have, which is the leader in the world. And yes, I do empathize with people who may not have a ton of flexibility or don't feel like they have adequate balance. But again, you kind of take it.
Ben's here every morning at 4 a.m.
So
you don't hear him complaining.
The unions are not happy, though. Michael Lindsay, a member of the engineers union, was quoted by the New York Times saying, people feel completely sold out. Now that it's after the election, there's going to be no accountability. And I have some sympathy for that, but also he shouldn't be surprised.
Yeah.
I mean, it's a politician. Fool me once, shame on me. Fool me twice.
Yeah.
Yeah.
Once everybody's in office, it doesn't really matter what happens. They can do whatever they want.
Moving on, oil. Oil's been a big topic of conversation. It continues to be a topic of conversation. And it has rebounded a little bit this morning on supply issues and also China reopening, potentially. We always have to caveat anything that we talk about with China because we don't really know what's going on there. We're going to just say what we think is going on. But on the supply side, OPEC Plus is considering more cuts. Again, this is a little bit of a shift from a week and a half ago where the Wall Street Journal reported that they could actually increase production in order to compensate for lost Russian production. But now it does look like there will be a cut when they meet on December 4th, which is the Sunday. Estimates are anywhere between 250,000 and 2 million barrels a day. So you could basically drive a truck through that. That's 0.25% or 2% of world oil production in a single month. So that would be pretty significant. Last month, they did 2 million barrels, but the functional reduction was probably a little bit less than 1 million barrels because they were underproducing already. So overall, this could be a little bit more of a significant move, and there is huge uncertainty as to what's actually going to happen with it. You couple the China reopening on top of that, and you really have these areas where you don't know where oil is going to break. What I would say in terms of what markets are telling us is that the futures curve has moved into contango. What that is a fancy word of saying that the spot price, the amount that you pay for oil today, has gone down about $10 over the last month. And the amount that you would have to pay for oil if you contracted it out into 2024 has not changed one iota. So basically that means that near term, you've seen a dramatic loosening of the market, higher supply, lower demand. But out into the future, there's really been no change into the underlying fundamental supply demand dynamics of the market. All this to say, I don't think anything fundamentally has changed. If OPEC Plus cuts by more than expected, I think that the spot price is going to go straight back up. That's my view. We did make a note of this in the market memo on Friday. It may not happen, but that would be my base case right now. And this is, I think, why some of the oil stocks are holding up better than the oil price right now. Tom, do you have a view on where oil is going to go as a result of this, or do you have any view of what OPEC Plus is going to do?
I think it's gotten extremely murky and it's gotten there very quickly. I mean, the China thing also threw a big wrench in it, right? Oil prices dropped. Everyone thought they're going to lock down. But they're walking that back too, which I think almost may make it an opportunity, right? We thought oil was going one way because China was locking down, and that might have been a long, protracted lockdown, but they're walking it back, which means that I think we could probably walk back the drop in oil prices as well. If you dovetail that with the fact that OPEC could potentially cut production by 2 million barrels, I mean, suddenly we could see oil prices going very high. So I still would argue that there's more risk to the upside. There's more risk that oil will be more expensive than less expensive. You kind of always have to operate that way, particularly when it comes to cost inputs like oil. I also think that we're going to see some situations where inflation, I think, ticks back up, based on the supply chain stuff. I'm a little bit worried about the bond market this morning. We've had a really, really big buy up on the long end. We've seen the 10-year drop. Yesterday it was at like 365, which is significantly lower than the highs. And suddenly, like we saw in the middle of the summer where everyone felt really awesome, inflation was coming down, everything felt, incredible, and the market was going up. We're seeing a lot of bond issuance on the corporate side, led off by Amazon this morning with almost a $13 billion deal that they're raising new debt. Because I think the indication there is we've seen the smarter, better operators attack the bond market when rates have dropped. And right after that, we've seen rates sell off quite a bit. So I would be prepared for, potentially some fireworks this week. We've got a lot of data coming out. So what I'm thinking is, are there longer bonds that we can lighten up on? Are there places where we can take a little duration off the table? Because, I think the risks continue to be the upside. Is it oil? Is it bonds? Is it, inflationary pressures? I still think that there's a little bit more risk there than there is, risk that suddenly everything's going to be awesome again.
No, that's a great point. I think, we've talked a lot about mortgages on this show and also just in person. And, for a while there, we were actually purchasing gingerly some mortgage-backed securities through a closed-end fund. I think that the purchase certainly is kind of off the table for now. And it may even be a potential time to start taking some profits in that. You're up 7 to 10% on that now. And in space of 20 days, take some off. That's a good return of fixed income in this environment.
Yes. Yeah. And I just think we're overbought, especially 10 years and out. On the short end, I think there's a ton of opportunity. You've probably seen in your accounts if you had bonds, but suddenly we're buying, short-term treasuries, medium-term treasuries, kind of in that 1 to 3 year range. And the yields on those are incredible. And I think that they're going to continue to be stepping up over the short term. But I just worry that the difference is you have almost no interest rate risk, right? You hold a 3-month treasury for 15 days, suddenly, it's a lot shorter and your interest rate risk is de minimis, versus a 10-year bond where suddenly you can get really sideways like we've seen.
All right. We will leave it there. Have a great day. We'll see you tomorrow. ADP employment number tomorrow. That comes out at 8:15. So we'll be able to talk about it on the call. We also have Intuit earnings tonight. So any read on business profitability from then will be interesting, and we will discuss that as well. Have a great rest of the day, and we'll see you tomorrow.